Hi Rajesh, thank you for joining us today on Leaders of Tomorrow. So your recently released report, Ask Private Wealth Hurun India Future Unicorn Index 2023, identifies the most promising Indian startups that are on the track to become unicorns in the next 2 to 4 years. Could you share the key findings of this report, like which sectors are leading and which cities are projected to have the maximum number of unicorns?
Sure, thank you. So firstly, the objective of this report is to highlight India's fast-growing startup ecosystem to both investors, governments, family offices, aspiring entrepreneurs, and the international community. I'll just share quickly some of the key findings. First, let me begin by classifying, or telling you how we've classified startups. One, of course, unicorns, as we call them. These are founded after 2020 and with a valuation of $1 billion. Then you have gazelles, which are likely to become unicorns in the next 3 years and maybe currently valued around $500 million. And finally, it's cheetahs, who will become or likely to become unicorns in about 5 years and currently valued at around $250 million. So that's how we classified potential companies. Key findings from this year's report is, first, of course, India is the home to about 83 unicorns, 51 gazelles, and 96 odd cheetahs. More than 80% of the startups achieved unicorn status from our last year's report. 24 from this list turned unicorns last year, and 3 have turned unicorn this year. We also found that 8 gazelles got demoted to cheetahs, and 18 actually dropped out of the index due to the funding winter. The entire list of companies on this Future Unicorn Index are worth close to now $57 billion, which is a 16% year-on-year increase. And this has happened also largely due to addition of new future unicorns. Bangalore was the startup capital. 53 of these companies are from Bangalore, followed by NCR at 29 and Mumbai 19. So these were the key highlights of the report this year.
Rajesh, tell us how HNIs or investors should approach the report in terms of making investment decisions on these startups.
So when it comes to wealth management or looking at HNIs, ultra HNIs, our advice as wealth managers is to really identify good quality funds, private equity, venture capital funds run by credible fund managers with a good track record to take exposure to these startups, because directly investing in startups come with their own risks. In terms of your ability to get details of how the business is doing and track it on a regular basis. So our advice is to really participate in these investments through good quality fund managers, and that's what we bring to the table, identifying fund managers who are really participating.
Rajesh, what advice would you offer young entrepreneurs, or startups who are facing challenges in securing funding for their ventures?
Not to give up. It's just a short winter. Winter passes and you have summers, and I think we're also at a stage where interest rates globally are peaking out. So you will see more money coming back to fund good quality businesses. And during the funding winters, or if funding itself is a challenge, focus more on tightening your belts, focus on costs, look at paths to profitability and not just growth. These are the things that I would recommend to a young entrepreneur.
Now, Rajesh, if you could also tell us, what is the role of a wealth manager today, and how has that evolved over time in response to changing market dynamics, technology advancements, and perhaps even evolving client needs?
Role of wealth manager, more than giving returns, is how do you manage risk. And as markets become slightly more complicated in terms of number of financial products that are available for investing, our role is to ensure that we are doing deep homework and ensuring that we are bringing only the right solutions to clients. Also, using technology and artificial intelligence especially to aid decision making for client portfolios in terms of optimizing their returns with the lowest amount of risk. And third, I would also say that creating good quality phygital models that is a combination of relationship managers who are personally meeting clients but they are being supported by digital tools to improve the way they offer or to institutionalize the quality of advice that goes to clients. These are two or three changes or trends that are happening. Of course, you can break the market into new gen and old economy. New gen is more engaged digitally, while clients who are slightly elder and have larger wealth tend to have a larger sort of interaction physically.
Tell us, what are the common mistakes people make, Rajesh, when it comes to managing their wealth, and how can they be avoided?
One key mistake always is to forget that inflation and taxes actually lead to destruction of wealth over a period of time. If you have too much of exposure in fixed income, or you are not investing in growth assets, over a period of time, the value of your wealth is depleting. So many allocate too much to fixed income, and they need to enjoy the growth story of India through equity investing also. Second big mistake is investing in products that they don't understand, or they have no idea how those returns will be generated, because the industry does come out with complex and innovative products, but innovation does not mean returns. In fact, we believe the more boring the investment is, the more time tested it is, the better chances you have to get your financial objectives met. So not going into too many complex and innovative financial products. And third is having diversification across all asset classes, not being overtly invested in real estate or equities or fixed income, but having the right balance, which can make you sleep well at night and still help you meet your stated objective.
In the context of a volatile market, how should one approach asset reallocation, to effectively manage risk and also optimize returns? What would you like to say?
So asset allocation calls are more important than timing the market. So when markets are volatile, sometimes people tend to remove money or get fearful of the future. And our advice as a wealth manager always is to try and rebalance portfolios whenever there is market volatility. Initially, when you sign up a client, to give you an example, if he's got 100 rupees divided between equity and fixed income 50-50, you may create a framework to say that anytime the value of his equity goes beyond 60, we will trim, or if the value of the equity falls below 40, we may add. And basis that asset allocation, what we call as a tactical or a strategic asset allocation decision we've taken, you may rebalance the portfolio whenever such market volatility takes place.
Finally, Rajesh, tell us, how do you see the rest of the year panning out for investing, and what would be the key risks to take note of?
We are quite excited about India's growth story from a medium and long-term perspective. In the short run, I think we are watching how interest rates pan out. In India, you're already seeing interest rates being paused because inflation is under control. In developed markets, there are still some more rate hikes, but the days of aggressive rate hikes are over. So our belief is towards the end of the year or early next year, rates will start looking down, and that will give a significant positive impact to equity markets, and especially India, compared to many of the other markets. The other risk that always remains is geopolitical risk related to what's happening in China, Russia, many other parts of the world you have to closely watch. But having said that, India's structural growth story is so strong in this decade. I mean, if you look at discretionary income, we've crossed $2,500 per capita income. Any country that crosses that, the consumption, then discretionary consumption then goes up quite dramatically, and you see a serious period of consumption stroke growth. If you look at our fiscal position, the way we managed COVID, the way we managed our finances, if you look at the investments that are coming into India, if you look at the focus of government spending on infrastructure, etc. I mean, I can go on and on about how the next 10 years is probably a golden decade for India. So while interest rates and geopolitical sort of risks you'll see and watch and see how they turn out, but having a slightly long-term view and remaining invested in the Indian growth story is going to reap rich dividends. I think more money will come into India and more wealth will be created in India than ever before.
Well, thank you for your time, Rajesh. It was lovely talking to you.
Thank you.
It's time for a quick break here. When